Happy King's birthday in Western Australia, JD. We got the day off over here. Mate, I don't really want to spoil it. I don't know where to start because a lot of people might not actually be expecting the pedigree of the great man that you've interviewed today.
I'm excited, mate.
I'm excited. He's reached the absolute top of his field as an athlete, and now he's now in his tenure as a fund manager, he's killing the charts once again. It actually reminds me pretty clearly of Axie's mining technology because they are the top name in drill hole orientation instruments and data management. Mate, if you're a geologist or a driller, get onto your team. Let them know you want a champ Ori and a champ gyro on site ASAP. The team at Axie's have all the surveying tools you need to make your life easy. Pick up the phone, give them a buzz. Numbers in the show notes. JD, what have you got for us today?
Mate, we have a conversation with none other than Chris Judd. So he's a man that needs very little introduction to our Aussie listeners. For those overseas who may not know, though, like you said, top-level athlete, now he's looking to do the same as a fund manager. He started his macro fund early last year. He'd been investing privately for some time before that, super keen on the investing world. And I was very excited to chat with him for a number of reasons. First and foremost, the Cerutty Macro Fund, it's in the name, it's a macro fund, and everything that has happened in the past couple of weeks has been all macro. You know, we've got the US rates decision a couple of weeks before that with the sort of yen crisis, appreciation, then quick depreciation, all this talk out of China, you know, stimulus and all that. So I thought it would be the perfect time to have him on. He views the world in a quite a unique way, quite different to the bottom-up fund pickers that we speak with. So we're going to run through his sort of macro themes, the trends that he sees playing a big role in markets at the moment. Then he's also got this sort of liquidity cycle lens through which he observes the market. Equally fascinating, seeing what central banks are doing throughout, you know, economies, whether that be the US, Japan, Australia, and then of course how commodities kind of pieced into his fund as a sort of protection against inflation and all other sort of sorts, with gold playing their role as well. So I think with all that said, mate, let's just jump to the conversation and hear it from the man himself, Chris Judd.
Can't wait, mate. Couldn't be a better time for a macro chat.
Chris Judd, thanks for making the time and coming on Money of Mine.
Thanks, JD. Big fan of the show. So very excited to talk to you.
Well, I thought it'd be a great time to get you on, given everything that's happened in macro. That's your focus of the fund. It's been a pretty huge week with the chock-a-block, 50 basis point cut from the Fed and then a few other decisions around the world. So how are you kind of seeing things to start? What's the lay of the land?
Well, the 50 basis point cut was really significant. And it sort of marks the start of a rate cutting cycle in the US, which has already started in other jurisdictions around the world. We don't view the US economy as being, we think it's softening, but we don't think it's dire or recessionary at this stage. So we think a 50 basis point cut was really aggressive. And we think we think asset prices are going to love it. And that's, whilst the initial reaction was very much muted, and there was talk even that the 50 basis point cut was a hawkish 50 basis point cut. I mean, I don't understand what a hawkish 50 basis point cut is. For us, it's a cut that was probably bigger than what consensus was initially, particularly before it felt like the Fed mouthpieces were trying to tell us it was going to be a 50 basis point cut. We think equity prices are going to love it, and they certainly proved that way overnight in the US.
So you've got these sort of three kind of channels which with you look at the kind of market. You've got the macro themes, the liquidity cycle, and then the bottom up kind of research. And this one really sort of plays into the liquidity cycle. Do you think we're at the kind of beginning where, it's perhaps a dash for traction staff in time as asset prices might inflate with liquidity measures sort of blowing out a bit more? Or do you think we might have that recession coming and time to be a bit more nervous and hold a bit more cash?
Yeah, look, this is the first time since we've started the fund about 15 months ago where we feel really bullish. So that's an exciting time for us. But we think, we're reasonably bearish on the economy, and we very much separate asset prices and the economy. I guess while we're bullish is largely around the fiscal situation the US find themselves in. So if you look at GDP in the US, call it around $28 trillion a year, and the trailing deficit of a bit over $2 trillion a year. So that 7% of GDP is now deficit. That's really significant outside of recession or wartime. And if you think those deficits are occurring at a time when you've got basically full employment, you've got equity markets at or near all-time highs, and property markets at or near all-time highs. So in terms of the revenues they're receiving from the tax base, capital gains is really high, stock-based compensation is really high, and income tax receipts are really high. And they've still got a deficit, north of 7% of GDP. Coupled with that, you've got $8.5 trillion worth of debt, US government debt, that needs to be refinanced within the next 12 months. So you're probably better at maths than me, but $8.5 trillion feels
not so sure about that.
$8.5 trillion feels like a big number. So
it does.
And this is occurring at a time when Russia's no longer allowed to buy US government debt. China's appetite for US government debt has softened after seeing Russia's FX reserves being sanctioned in 2022. The Saudis, while still buying some US government debt, are buying more gold to store their surplus reserves than they used to, and storing some of their surplus reserves in soccer teams and infrastructure projects and places they haven't in the past when we were in the petrodollar system. So we think, the central authorities in the US to deal with that environment are left with sort of four options. Their option one is they can just term out their debt at a much higher interest rate than they're already paying, which is going to be really hurt that deficit spending even more because their interest payments are going to go up. They can just refinance that debt in short-term government debt, T-bills, which they're doing more of. I mean, it's unrealistic to expect they could do the whole $8.5 trillion in that way, but let's say they want to do that, but that's obviously at a higher interest rate than they're currently paying, and there's a view that that's inflationary because the shorter duration you get, the more akin that becomes to looking like cash. And it also doesn't solve the problem. It still means you've got to refinance that debt within another 12 months. They could cause a recession and refinance it at a much lower interest rate, but that's going to really hurt tax receipts because you're going to get income tax go down, you're going to get capital gains and stock compensation go down, and your entitlement spending is going to go through the roof. So that seems unattractive.
Politically, there's not much appetite.
No, so then what's your fourth option is to drop interest rates outside of a recessionary environment. You boost tax receipts by boosting capital gains and stock-based compensation. You also lower the cost of interest you've got to pay on those new bonds you sell. And we think that's where they land at. We think that's the situation we find ourselves in, which is bad for things like inequality and social harmony, but we think it's going to be really good for asset prices.
There is so many avenues to run down there. I think the underlying one is inflation. And you made the comment in the past that you think it's sort of stubbornly kind of baked in, and that's going to be the case for perhaps the next kind of 10 years. Is that a theme that you think is going to play through to the 2030s or maybe even longer? And that sort of, how does that kind of dictate how your fund plays that in the longer term?
Yeah, I guess without any government interference or central bank interference, we think the most likely outcome would be a deflationary bust. But even any sort of deflation, when you've got government debt to GDP at 129%, deflation's terrifying when you compare it to inflation. So we could see a scenario where you get either deflation or inflation, but we think when push comes to shove, the choice will be inflation because that's the only political way to pay down the debt in real terms, not in nominal terms, but in real terms. And that was certainly the avenue the US went down post World War II, which was the only other time when we've had government debt to GDP this high. So, we do think it's worth sort of splitting up inflation into different, there's CPI or Main Street inflation, and then there's monetary inflation. We think those two often get sort of mixed up, but broadly speaking, we think both those things will be higher than they have been in recent history, in particular CPI. When we had a huge monetary inflation post-GFC in things that have been financialised, but we didn't have any of that CPI inflation. Now with fiscal spending in the US roaring back to life, we're starting to see that Main Street inflation. And we think it's not a great outcome, but it's the better outcome when you've got debt to GDP this high.
So how does that kind of play into how you think about commodities, real assets, all these sorts of things. Are you potentially playing a portion of that through financial assets that you think will inflate, and then maybe hedging your bets a bit with commodities, housing or REITs or whatever, just give yourself a bit of a cushion that the actual value of that is not being eaten away in time?
Yeah, so I mean, we don't have a heap of commodity exposure. We've got some gold exposure, which is more a monetary inflation hedge. I mean, you look back to how confused and angry everyone was when CPI was ripping and gold was soft. So, I mean, we think that's what can get missed with gold. It's a hedge for us against currency debasement. We view gold increasing supply, a bit over 1% a year, and money supply in the US on average increases supply at around 7% a year. And we think that's why gold is such a structural long-term bullish bet. That doesn't necessarily need to mean revert like other commodities. So it'll still get overbought and it'll still sell off at times. Clearly, nothing goes up in a straight line. But we sort of have a different view of how that could behave compared to industrial commodities, where they might have a run, but we think over time they do end up mean reverting as supply comes on board.
Does that gold just become a sort of cornerstone with the idea of you might be holding that for quite a while, unless you see a real change in government attitudes and action towards austerity, which doesn't seem to be.
Right. That's right. And even then, in a deflationary bust, gold's not a bad place to be. So it can sort of play two roles in a portfolio. So I mean, it was so odd. Post-COVID, US, you had money supply rip, I think it was about 25% in a year at one stage. And then you had negative money supply, which is just unheard of. I think you had to go back to the Great Depression, the 1930s, to actually have negative money supply. So that's a time in the short term we'd be nervous about holding gold because money supply is becoming more scarce versus gold that's increasing at about 1% a year. But if we stayed in that world for too long, we could see the whole financial world crumbling. And in that situation, having gold is not a horrible place to be either. So in the interim, if we were to see negative money supply again, we'd be hesitant to hold gold perhaps in the short term. But if that were to go on for long enough, then gold would essentially be attractive in a different way.
I'm keen to maybe take a big step back and understand why you structured the fund as a sort of macro kind of top down to start with. We've spoken with a bunch of fundies over the past year or so, and almost all of them are bottom up. They might have a bit of an overlay and try and understand commodity or whatever, depending on what type of sector they focus on. But it's quite rare we get people that have it, written out in the mandate. Macro themes is the top point, liquidity cycles. Why is that just a personal interest? You wanted to start the fund like that?
Well, it's both. I mean, the most important thing, I guess, is we want different results to the average fund and certainly the index. And we've never understood people that want different results but have the same processes as everyone else. That doesn't make a lot of sense to us. And I guess that's a reference to my experiences in sport. You see so many people talk about wanting their team to have a different outcome, but when you looked at the way they trained and the way they thought about high performance, it was exactly the same as all the other teams they were competing against. That always struck me as odd. But more personally, I think post-football, it was just macro investing that really energised me. So I started working as an analyst at a VC fund post-football for about 18 months. And was really lucky to be given that job, and they were a really good team to work with and to learn off. But I can still remember I was driving around in between meetings and I listened to the first macro podcast that had come across my desk, which was Grant Williams. It was a podcast he doesn't do anymore with two other POMs. And it was just something had been set off in my brain. And I'm always acutely watching when I'm doing something that's really energising, because it's sort of a clue that's where you should be directing your energies.
Yeah, sort of ebb into your interests, right?
That's right. And it was really that just sparked this interest that became more of an obsession than anything else. And I could just find myself consuming 6, 7, 8 hours of content a day in that field and not being tired by it. And that felt very different to, if I spent 6 or 7 hours doing bottom-up analysis on individual stocks, I'd find that really tiring and exhausting. Whereas the macro stuff, I could just keep going and just loved it. So that's sort of how it came about. So that's because I found it interesting. That's how I invested my own capital. And then I put on Tom, who's the current analyst for Cerutty, about 4 or 5 years ago now, when I was investing in a private capacity. And then we got approached by a family office a couple of years ago to take some outside capital. And we initially agreed to do that. And once we worked out licensing and just how expensive it is to do that properly, we just thought it was time to take the plunge and start a fully fledged fund. So that's how Cerutty began.
So why the equities only kind of lens? Because I read about these macro investors as well, and it's fascinating. It's kind of mind boggling. You read about Soros and Druckenmiller, and they're using every tool in the drawer, currencies, commodities, actual storing physical commodities, derivatives, and all these sorts of things. Is that more a point of selling that as a fund is very hard to understand to outside investors?
I think you've got to understand where your limits are and what your skill set is. And, I can make good investments on themes that I think will work. Timing is not my long suit. I'm not a technical trader. I'm not brilliant at timing the market. And I don't want to chuck a heap of leverage in because equities is about as comfortable as I can get with my risk profile, particularly taking outside capital. I've traded commodity CFDs before privately and done really well out of it, but I couldn't sleep when I was doing it. There was no longevity in it. Whatever you're doing, it has to be repeatable over a long period of time to work. And I know that during COVID, trading CFDs that would give me up to 400 times leverage on these. I wasn't going that extreme, but it's pretty wild. And, the kids would come up and they'd be talking and it was just no good. Even though it was a profitable experience, I just thought I couldn't do this for a long period of time.
Yeah.
And so, we've just got no edge in that space. At least with equities, we can clearly articulate where an edge lies. Like we're a small fund. When liquidities, we're in a good liquidity environment. We want to invest largely in small and mid-cap companies where larger funds can't play because they can't allocate enough capital to. When those equities are in Australia, we can meet management, even as a fund our size. And I guess we want to find the least sophisticated counterparty to the other side of each trade. So in small cap equities, when we're buying or selling, it's quite likely the person on the other side of that trade is a mum or a dad that's working full-time, doesn't have access to management, gets overly emotional either way, and we feel that's an advantage for us. If I'm trading FX or commodities, bloody Druckenmiller's potentially on the other side of that trade, and good luck. That's sort of why equities only, albeit from a top-down view, we feel works for us.
You've mentioned in the past you've got a bit of a value bias, but you didn't say that in sort of glowing terms. It was more like a real bias that you have to actually fight in the portfolio so that you don't get sucked into a portfolio of all one and the same type of thing. How do you think about that and sort of managing the portfolio more broadly?
Yeah, something I want to be really conscious of, and the investors I admire the most are ones that are able to earn money in different environments. And, in a really tight liquidity environment, sort of low PE stocks can do really well on a relative basis, but it's not necessarily where you want to park all your capital over the long term. And I think it's just a case of when I first started reading about markets in my 20s, I read all the Warren Buffett stuff, and he's obviously, the world's most famous value investor. And that all intrinsically made sense and worked until you see, companies like, Facebook back then, or Google or Apple to a lesser extent, or companies that certainly on a PE basis were bloody expensive, but just kept going up and up. And it really had to change the way I view markets. And now, I guess we almost view our market as a bit of a football team. We have some positions which are defensive. We have some positions which are like midfielders, which might be higher quality companies, but are neither really cheap nor at the spivvy end of the market. And then your attackers, which are perhaps Spearview are non-cash generating yet, but have huge growth potential in certain environments. And then your cash is almost like your interchange. You can turn in and put it more in defensive positions, mids or attackers, depending on what the market's giving you.
Do you sort of prefer to be fully invested or always have a sort of pocket of cash there in case? What's your kind of philosophy on that?
Well, we prefer to be fully invested because we think that means liquidity is good. And that's a preferred environment we'd like to be in. But if liquidity is tight, like when we first started the fund, I mean, we had 40% cash first month or two just because we couldn't get it out the door as quickly as we would have liked. And then, liquidity was pretty tight, so we were sitting at about 20% cash. But yeah, we would like to be under 10% cash. We have less than 5% cash now because we like I said, we're pretty bullish what's going to happen over the next few months.
So looking forward then to the next few months, you've spoken about these macro themes that you break it out. The ones that are probably sort of near and dear to what we speak about on the show pretty regularly are the electrification of everything. We've touched on data center, CapEx. There's a whole bunch of other ones, cost of living kind of crisis across Australia and the Western world more broadly. What are the ones that are sort of, filling up your brain space at the moment, the ones that are getting you most excited?
Yeah, I mean, AI has probably been the biggest, in terms of thematic investing, that's probably been the biggest theme since we started the fund. We haven't had really clean direct exposure there. We haven't owned NVIDIA, or any of the other chip companies that have clean AI exposure. But one thing we have had exposure to is that data center CapEx that you speak of. That's pretty predictable in terms of the billions of dollars that's been committed to that space going forward, both here and abroad. So that's been a theme we've really liked. We play that through an electrical engineering company, which is a big beneficiary of that space. Aging demographics is a really predictable long-term trend. Currency debasement we think it's a predictable long-term trend. The electrification of everything, we see we don't have a lot of commodity exposure at the minute. We've got gold, and the other main commodity which we like at the minute is uranium, which plays into that electrification of everything and decarbonisation theme. And probably also, I think, the modelling for EV uptake was too aggressive, and likely we think the modelling for how effective solar and wind can be for baseload power has been too aggressive, and we think over time uranium is going to be a big beneficiary of that.
How do you expose it? How do you get your exposure to that? Do you just get a basket of miners? Do you buy the Sprott physical trust? What do you do there?
Yeah, so we get a basket of miners. So because we're not technical, we're not geologists, we're not overly technically skilled when it comes to analysing mining projects, we don't want to express a positive commodity view with one stock, because you can get the metallurgy wrong and miss the trade even though your thinking around it was correct, and that sort of drives us crazy. So generally for us, we'll get a basket of usually 3 or 4 stocks that we like to express that view. The Sprott Uranium Trust is an interesting one where it's sort of a safe way to play it, and it makes intuitive sense, but we just felt if that runs and the uranium price runs, the miners are probably going to outperform. And if it doesn't run, then you don't want to be there anyway. Like it's a less volatile way to play it. And, miners mining's such a bloody hard industry. It's a way to be in the trade and be right, as opposed to potentially being the miners, be right, but still lose money. So I get the urge to be in that, but for that trade and getting back to that team side of it, those uraniums are really an attacker for us. Like, if that trade works, we want them to really go. We're not shooting for 20% out of them. And that's that role it's playing in the portfolio versus maybe a low PE stock we might be in, where we could say, if things go well, we hope this makes us 20% or 30%. The uranium's a really aggressive way to play. Basically a secular theme we like, but also be there at the turning of a liquidity cycle.
So you wrote about uranium pretty early in the fund's history, maybe October or something last year. How's your thinking kind of changed? Because we saw the spot price, surge up. almost 100 or whatever. Then it's pulled off a bit and everyone's talking about what's happening in the term market and things have pulled. The equities have peeled right off. Is it a trend you just see consistently playing and you use this opportunity to buy up, or have you just held it through?
No, we've traded it. So when we buy something, we want to hold it for 2 or 3 years. That's the mindset we're going into, or longer. But we hate holding stuff that we think is now overvalued. So, I mean, we initially expressed the uranium trade through Boss and Paladin. They ripped and they just started to look really expensive to us, and we sold both of them. So we no longer hold either of those stocks. But we still like the theme. We just thought, every second crypto bro was tweeting about it. Positioning wise, it just felt like it was toppy, and we just felt like those things were overbought. So we sold them, luckily timed it well. And then we bought back in some different stocks to express the same view recently, because we felt it was more positioning based that crunched uranium equities than anything that was actually happening. So we felt there was a lot of crypto bros in the uranium trade, and crypto was getting smacked around a bit. And we thought the other people in the uranium trade were commodity guys, and commodities were getting smacked around a bit, and particularly lithium. Like, lithium's such an aggressive commodity play, as is uranium, and we just felt people were treating that as a similar trade, where we felt, long term, the amount of money that had gone into increasing lithium supply was very different to uranium. But we felt uranium was getting punished, even though, like you said, the long term price for uranium wasn't getting punished. The spot market was, but as is regularly spoken about, that's not really the market to be aware of. So that was sort of our reasons for re-entering the trade. And whilst we like uranium on a 10-year plus basis, if it rips what we feel is too much, we'll sell it or shave down some of it again, even though we still like it on a longer term basis.
So you've touched on lithium there, EVs, the trend, perhaps like hybrids kind of playing into that conversation as well. How do you think about that now? It's been so beaten up, the equities in particular, even the commodity itself, it's really in the doldrums. Does that sort of discussion, that sort of sentiment get you excited with your kind of contrarian base?
Not for lithium, no. We missed lithium in the fund on the way out, and I missed it as a private investor. So that always hurt. But then I felt smart.
Just forget about
it. But I was a big cobalt guy years ago, 17.
Okay.
Cobalt trade was brilliant for me.
You played Jevois or?
I played Clean Tech back then, the Friedland one.
Okay, yeah.
So that was a really kind position. I mean, I played Jevois as well, but Clean Tech, now Sunrise, was the one at the time which made me smile. But I never,
Things can change so quickly, right?
They can. So, I just think so much supply came on with lithium. So many people were in the trade. And the forecast for EV demand was so extreme. And it turns out a lot of people just don't want EVs. The resale value is shocking. People get range anxiety. The batteries don't last as long as people would like. And hybrids, you could see a world where hybrids are a much more attractive option and much better for the environment too, potentially. So, that's a long way of saying we never got in lithium, and we felt it was really concentrated around the EV trade. We had some chunky copper exposure at one stage, but we like copper because you got the data center exposure, you got the renewable exposure, you got, Bitcoin mining. Everywhere you look, things are being electrified, and we felt copper played into that in a much broader way. Whereas perhaps lithium, where it was a really concentrated bet on EV take-up.
Yeah. So how do you kind of think about copper now, and by extension, what are you thinking of China more broadly? So much of it's been dictated, in particular last year with the treatment of refining charges being tweaked in China. But copper and then China, what's sort of on your mind with those two?
Well, we're sort of nervous about China and their economy, I don't know, medium, long term, but so is everyone.
Worrying, mate, worrying. You know what would make worries go away? When I'm worried, I just think of one thing. I need to pick up the phone and I need to call the good guys at CRE Insurance because they make my worries go away.
Mate, Steve, Ads, Tari, they are more than happy to help. It's it's a complex world if you haven't sort of picked that up from what Juddy's said so far. But these guys, they thrive on complexity, don't they, mate? They will go to any corner of the globe, Africa, North America, South America, Asia. These guys will do it all. Any commodity, anywhere, any sort of scale, not even just mining. If you're in the energy world, manufacturing, construction, these guys cover it all. And even better.
I reckon
Trav,
Juddy got his Brownlow medal insured by them just in case it went missing or stolen.
I would.
Yeah.
That is what I would do if I was him.
Yeah.
Absolutely. And I mean, the good thing about these guys, offices in Perth, in Sydney, in Brizzy, you can see them face to face. Just get in the show notes, give them a call, take things from there. They can run through your current policy. Even better, you can see where there's holes where you're exposed at, free of charge. It makes no sense not to do it. They provide tailored insurance. They cover any quirks your projects might have. Look after your business, pick up the phone, do the right thing, give them a call.
Sounds good, mate. I know that you like to save money and save costs everywhere. Well, a free insurance check sounds like the perfect thing for the penny pinchers out there like JD. All right, back to the show.
So it's hard to know what is already in the price there. I mean, the stock market in China has been a horrible place to be for, I think they're coming up to their fourth year of negative stock market returns.
Sound about right. Because sort of 21, they really went in hard on their tech names, tried to smash them up themselves.
That's right. Or the education businesses got zeroed. And so... and the property market's been really hurt in China, which is obviously a huge driver of iron ore and met coal prices in Australia and around the world. So, China's export market is still really strong. So if the commodities linked to Chinese exports, like EVs, where they're exporting a ton, and copper plays into that, we still think it's reasonably attractive, albeit copper's also linked to the Chinese housing market, which we'd be really nervous about. The bulks would be nervous about for that same reason. But, nuclear power capacity in China is just exploding and looks like it's going to be exploding for a long time to come. So we think uranium, even though that's linked to China, is still bullish given what they're passionate about. We also think, and Louis Vincent Gay's written about this a lot, which thinks an interesting way to look at things is which market does the government want to protect? In Australia, the government really wants to underwrite housing. And you can see that from the various policies they implement. It's all designed around boosting house prices and keeping them high. In the US, it's equities, it feels like. That's the market the government is constantly trying to goose.
You can't have a down week.
That's right. And in China, that's more and more appearing to be their bond market. Their bond market's really strong. Bond yields are lower than the US. That appears to be the market where that government's sort of looking to underwrite it, and certainly not the equities. And equities are very much under-owned by the average Chinese resident. Properties owned, a lot of their wealth stored in property. And you've seen some measures recently where they're trying to stimulate property or take some pressure over people that have property debt. But we're conscious of which assets in which jurisdictions are the ones where the government are really trying to underwrite it. And certainly in China, it doesn't feel like it's equities.
Yeah. The sort of negative wealth effect that could be felt, something of concern for the CCP to really protect, right, to look after those property values.
That's right. And then I think it's Louis Vincent Gay again, has the view that they haven't been able to stimulate their economy before the US starts their rate cutting cycle. And you could see that potentially being true. So they've had little bite-sized pieces of stimulus recently, China, but nothing that has really moved the needle significantly. Now that the US has cut 50 basis points, you wonder if there's the potential for them to stimulate a bit more aggressively without putting pressure on their currency, because I think the traditional model of China just devaluing their currency in a time when their consumer spending is so low and the part of their economy they really need to get going, if they just keep devaluing their currency all the time, their exports are already flying. Like, they don't need any more export growth. They really need to stimulate that internal consumption, and a deval certainly doesn't feel like it's going to do that.
Yeah, it'd be fascinating to see what plays out in November in the States, and whether these heightened tariffs come through, and what that kind of means. When you look across the world, are there other regions, countries that kind of get you excited? I guess the kind of trend we've seen is people pretty bullish India, pretty bearish the EU, these sorts of things. Is there pockets that you look to play out there?
Look, India is the one that feels like it's the most attractive, for a number of reasons. Like the demographics are really good. They're a democracy, highly tech-savvy population. So we've looked at it, but for us, their companies are bloody expensive. I don't know if you ever looked at them. They're so expensive. They're also short oil, so we don't hedge currency. We could have seen a world where maybe the stocks went up, the currency went down, and we were no better off. And we think, that underinvestment in oil, we don't think oil's going to rip to $200 a barrel, but we think it's going to be reasonably strong over a long period of time. We think that's going to hurt India. The other thing we think is so much of their more investable businesses around IT outsourcing. And when you think at which industries is AI potentially going to rip apart, outsourced, reasonably low skilled tech services is going to be at the forefront. So we don't have any exposure there. We have very limited overseas exposure, full stop. It's really only when we see something that feels so obvious we almost can't not play there, we do something. So we've got 3 Japanese supermarkets we're invested in at the minute, which we view as sort of one position. Not because we've got an edge in Japanese supermarkets, but just when we saw the yen get to 161.
Yeah, let's talk about that.
I mean, it got 161 against the US dollar, and it might have ticked 109 against the Aussie. So
up and down in a month.
Yeah, so like for us, like we saw that, and you look back, and it's sort of 150 to 100 versus the US dollar is sort of a reasonable range for the yen, and the Aussie, call it 100, between 170. Is a reasonable sort of range. And so when the yen just ripped, when the Aussie and the US dollar ripped against the yen at a time when the US was going to start dropping rates and the Japanese central bank said they're going to start raising rates, and Japan's got inflation for the first time in forever, that just felt like a trade we couldn't ignore. So that is almost a currency trade for us, really. I mean, supermarkets generally do reasonably well in an inflationary environment. The companies we're in a good balance sheets, significant amount of yen on their balance sheet, and their revenue is all in yen. I mean, that was one of the hard things when we decided we just had, and it's a pretty small position for us, but we decided we had to do something there, was so many of the good Japanese companies are exporters earning USD, which isn't going to help you expressing that trade. So, the overseas stuff for us just gives us a flexibility which other Aussie funds don't have, or a lot of Aussie funds don't have. If we see something like that, I mean, we almost have a bit of muscle memory dating back to, you remember when the Aussie hit 110 against the US?
It's gone back a while now.
Yeah, was it like 2010 or?
Yeah, around about 10 to 12.
Yeah.
When iron ore was just flying.
And you just had to buy something. I bought some Google shares. You just know it's not going to stay at 110. So
take the family, go to America.
Yeah, that's right. That's right. Otherwise, that's what you can go to Japan for a holiday.
Yeah.
But it just felt like that sort of moment. So, I mean, the Aussies bounced back a bit against the yen today. But that's quite a nice trade for us. And it's a bit of a natural hedge because, I mean, we were in diggers early August.
Yep.
And that strengthening of the yen just ripped markets apart briefly as the carry trade unwound.
Hang on a minute there. Chatting about conferences, diggers, got me thinking. The ADIA Drill 24 conference is only 21 days away. That's 3 weeks left to scoop up your tickets and get yourself down there.
3 weeks, mate. I'm getting a bit itchy. 21 sleeps to go. It's running from the 15th of October till the 17th, just down at the Perth Convention Centre. That is all you need to know, money miners. Get on down there. It's going to have all the latest drilling equipment, tech. There's going to be reps from all the big miners down there. And if that wasn't incentive enough, you got Matty Michael doing a bit of emceeing. We're going to be floating around. There's a couple events in the evenings, a couple great chats that we're keen to get down and see. I think it's well worth your time. All the details are in the show notes. Just get on down there.
Matty Michael's not a big enough draw card for me anymore. You brought Chris Judd to the podcast. You know, you got to tell me Juddy's going to be there too. In fact, Juddy's going to be there. He'll be there.
He is, mate. We were chatting about it. He is pumped. October in Perth. Get your tickets. Go ADIA.
Cheers, ADIA.
That volatility sort of surprised you?
Yes, it did.
Wild.
It was wild.
And then the futures on, the S&P 500 and everything, it was, there were some nervous faces on Sunday through Monday. It's turned out to be a big kind of nothing burger in the end, but a lot of it's unwound. But the Nikkei was down 12% on the first day and then sort of recovered a lot of it. Do you think there's, that sort of volatility is going to be sort of theme we're going to see more of?
I think so. Yeah, I think so. When you've got this much debt in the system and momentum's become such a big part of trading, and then you've got so many trading decisions not even made by human actors now, I think you've just got to embrace that volatility and rather than try and smooth it out, I think just embracing it and accepting it is a better way to go.
Is passive investing one of the trends you kind of look at? I'm not sure if you've heard of Mike Green or seen him on Grant Williams, I think, a couple of times. And the way he's kind of laid it out just kind of made perfect sense to me. But ultimately, it's more volatility because it's more and more passive dollars just chasing the same names. As they get bigger, that compounds, they get even bigger. Is that a trend you see an opportunity to play in as an active manager? Yeah,
well, I mean, there's no doubt that when companies... If you look at what's been the most effective investing side for a long time, it's been momentum. And that speaks of almost a non-economic buyer as people, and often young people, invest in index funds. Those index funds are forced to buy whichever companies. And it doesn't matter what price those companies are at, they're going to buy that stock. And so we've just got to be aware of that. And you can see as companies outperform and they grow and they get included in those indexes, you often get a nice bump as an equity holder. So it's something we're aware of, and it's something why we view the Aussie banks have performed so well because CBA in particular plays such a big role of those the ASX 200 as an index fund. But it also speaks to the power of buybacks too. Like we've seen how powerful buybacks can be with companies we own, particularly when they're small and largely illiquid. And we think that speaks to the same type of phenomena you get from index investing when a company is buying back its stock. And it still depends on price to some extent, but they're sort of committed to buying that stock with cash that's already there ready to go. So
it gets exponential, right? The more and more they buy back, it becomes a greater portion of their stock that they're buying back. And the returns, once they've sort of bought more than 80%, I think it's something we could see in some of the coal names in the next 10 years, because the lack of active managers that can buy them, right?
Yes.
And it just shoots up kind of sharply.
And it speaks to flows, the importance of flows in investing. So that's what, if you look at Aussie smalls and really micro cap names, there's just been no buys. There's been no flows and they're not getting any index flows. And we think why there's no buys is because cost of living is just smashing people at the minute. And so we don't think that liquidity for those companies that rely on retail investors, we don't think that will be back until you actually see rate cuts in Australia, particularly at the smaller end of the market. So,
how do you think about rate cuts in Australia? Is that sort of mid-25 you're kind of thinking?
Yeah, we think it's February or March next year. I'm not sure what consensus is. I think Barrenjoey have February. We just think once the US start, we think we're probably going to go within 6 months of that. We didn't rise our rates as quickly, and our inflation's been a bit stickier. And we've jammed so many people into the country. 600,000 people jammed into a country our size, whilst that may ease some of the wage inflation, the inflation on shelter and power and food and used cars, naturally it's going to be a lot stickier than it would be without that population increase.
So do you try and play, a lot of them are kind of gone bust, but like home builders or something like this, like just ways in which you can play government infrastructure build outs, housing build-outs and these sorts of things? How do you kind of think about that?
Yeah, no, we haven't played home builders at all. And I guess one of the challenges home builders are facing is they're being crowded out by public spending.
Yeah,
and they've
got inflation as well.
They've got to compete for labour with government infrastructure projects that are quoted at cost plus, and there's been everyone's like, good luck. So, I mean, something like childcare, we've got exposure to a childcare company we like because cost of living, everyone's got to work. It's not like we in an era where you could have one income supporting a house, unless that one income's ginormous. So, childcare would be an example that's going to benefit from population growth at a time when it's going to be a potential vote winner for Albanese. So he's out there talking about different measures to encourage staff increases to childcare workers, which the government's going to fund. And it's one of those businesses where their costs go up, but basically all those costs, or 70% of those costs, get passed on to the government at the end of the day. So they can maintain their margins really well. So that would be an example of a pretty simple business that should benefit from population growth and cost of living pressures internally.
What about super flows? That's another one I heard you mention, and it's a enormous trend we see in Australia specifically, and everything we just mentioned plays into that, right? Aussie super and the like just get more and more dollars no matter what, just pumped into them. How do you see that playing out? And again, are there ways in which you think you can kind of piggyback on that, or is that just a good trend for the ASX to have with dollars going in?
Yeah, it's a good trend for the ASX to have. Like, we've been in and out of the platform stocks before, but they're an obvious beneficiary of that. Even some of the ancillary businesses around funds, that service funds where the funds have to be each year, benefit from that. But like you said, there's just money coming in year after year. It's really predictable. So that's another one of those long-term trends that feels easy to predict, and just an enormous tailwind that you don't want to be backing against. And the inverse of that would be sort of an industry like gambling, where you just feel the asymmetry is sort of wrong. Either those companies don't make money, or if they do make a buckload of money, the government's just going to come and tax the absolute crap out of them because no one feels sorry for a gambling company. So we're conscious of those different dynamics, and we've just found it's easy to make money in sectors where you got the wind at your back instead of the wind in your face.
The last sort of big trend I'm keen to touch on is friendshoring, reshoring, whatever you kind of call it, deglobalization. This was, all across the headlines maybe 2-3 years ago on the back of COVID. It's gone a bit wider. Do you think that is a trend that was perhaps overstated, or do you think that is something we are definitely seeing and perhaps underweighted still?
No, I don't think it's overstated at all. And, the recent situation with the Israeli pager situation with Hezbollah probably reinforces another micro example of why it's going to become more and more important going forward. I think that speaks to, we think that's going to be highly inflationary because being able to manufacture, the vast majority of goods in the lowest cost country is a really cheap way to live. But if we're moving towards a world where there's potential for a hot war, and we all hope that doesn't happen, but I guess everyone would have to think that's a possibility in the next 10 years. It's not going to work for America to ring up China and say, hey, we're keen to go to war in 6 months, but we don't have many bullets. Can you send over a truckload of them to us? So, we think, the US has started CapEx spending on building out their own internal industrial base and ability to manufacture goods. We think for that to really work on a long-term basis, the US dollar needs to be lower than where it is now. And Trump's spoken about having a weaker US dollar. Kamala's policies sort of point to the same thing. And so we think rebuilding that industrial base in Western worlds is going to be a long-term trend. We don't think that's just a COVID thing.
There was one other thing that stood out, doing a bit of research on your website that I was keen to touch on. You compared investing against the investing business, and it really hit home the kind of contrast that you see. Can you kind of expand on that? I'm keen to.
It's really different, and like even our business our fund is not a great fund to sell, because most funds, they go to an allocator and they say, look, we're your growth partner. We're going to invest in growth stocks, or we're your value partner. We'll invest in value stocks, or, we're your commodity fund. We're just going to invest in commodities. And the allocator can make a call, I like growth, or I like value, or I like commodities right now. I'll invest. Whereas, my fund sounds like a word salad. Like we're going to invest in high conviction bets, depending on what the liquidity cycle is doing, and on long-term secular macro.
They've lost him.
They've lost him. They're like, what's that? So
Yeah.
we think for us, that's the best way for us to be able to make money over the long term. And, my liquid capital is in this fund, so I don't have the luxury to be investing elsewhere when the cycle turns. So on a long enough time frame, we think it's the best way for us to invest given our skill set, but it's a messy fund to market or to sell because it's not a neat growth, value, commodities, name your other idea.
Do you think that issue with the broader investment management market is in a way your edge though?
We think it's an edge being small. Yeah, we think, anytime I do some finance content, and anytime I spoke to different fund managers, they'd say, it was so easy when we were only managing 200 million bucks. Now we've got over $1 billion bucks. It's so hard for us to outperform the index. And it always begged the question, why not stop at 200? And the answer is, of course, management fees are a hell of a drug and recurring revenue is great, and I get all that. But for us, we've got a bit over 30 million bucks under management now. Our lofty goal is to get to 150 and do a hard close of the fund. And then we hope to grow the capital to 300 million, give everyone half their money back. So we're always protecting that edge of being small. And even, because a chunk of the capital is our own, it's just so unlikely increased management fees would outweigh the benefit we get from being able to get in and out of under-researched opportunities. So that's very much the mandate and something we plan on sticking to.
Last question, what is behind the name Cerutty?
Cerutty, so it's named after Percy Cerutty, who is Herb Elliott's athletics coach. So Percy was almost dead in his 30s from ill health, and then took up running and became obsessed with diet. This was back 80 or 90 years ago, and became obsessed with eating, nuts and fruit and vegetables, and hated white flour at a time when conventional wisdom was very different, hated sugar. And then he ended up coaching Herb Elliott. He was still doing PBs in marathons into his 50s or 60s. He was annoyed even in his 70s when he wasn't doing PBs for marathons. So the relevance to the fund is he was late to his profession of athletics coaching. He was a first principle thinker, so he didn't just follow the conventional trends of the day, and he could put up with more pain than most. And as a fund, we want to embrace volatility rather than trying to smooth it out. So that was the relevance for how we want to invest.
Admirable traits. Chris Judd, thanks for making the time.
Thanks, JD. Great fun.
Beauty.
That was wicked, mate. I feel electrified. I'm invigorated.
I was pretty pumped to share that one with the Money Miners. I thought how we kind of ended the chat and what Chris has in store for his fund, his sort of ambition and the way he thinks through things are fascinating. So very excited to share that one. And I think we can leave it there, mate. Money Miners, have a awesome public holiday if you're in WA. We'll just round out by thanking the good people at Axis Mining Technology, Mineral Mining Services, VRIFY, ADIA, DSI Underground, Silverstone, CRE Insurance, who we had in the show, Greenlands Equipment, K-Drill, and use the Spark Chart, guys. Hoodaroo.
Hoodaroo.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.